Hi all, welcome back to Finalit YouTube channel. Today we are going to discuss about business funding and shareholding patterns. The topics you will learn today: promoter, angel investors, venture capitalists, private equity investors, company valuation, and shareholding pattern. Assume Mr. Bob has brilliant business idea and he is confident that the business will be successful and he can start a company. Here, Mr. Bob is called a promoter of the company. But where can he get the money to fund the idea? He could approach the bank for a loan as well, but this would not be the best option. Let us assume he pools his own money and also convinces two of his good friends to invest in his business. These two friends are investing at the pre-revenue stage and taking high risk as the promoter takes. Hence, they are called the angel investors. The money from the angels is not a loan. It is actually an investment made by them. Angels invest relatively a small amount of capital. So, Mr. Bob, the promoter, along with two angel investors, raise 50 million in capital. This initial money to start his business is called the seed fund. Once the seed capital deposited in the company's bank account, the money will be referred to as the initial share capital of the company. The share certificates of the company, which entitles three of them an ownership in the company. The only asset that the company has at this stage is cash of 50 million. Hence, the value of the company is also 50 million. This is called the company's valuation. The company assumes that each share is worth 10 rupees, and because of there is 50 million rupees as share capital, there has to be 5 million shares with each share worth 10 rupees. In this context, 10 rupees is called face value of the share. The face value could be any number. A face value is simply a denominator to indicate how much one share is originally worth. The total of 5 million shares is called the authorized shares of the company. These shares have to be allotted amongst the promoter and two angels, plus the company has to retain some amount of shares with itself to be issued in future. So let's assume the promoter holds 40% of the shares and the two angels get 5% each, and the company retains the remaining 50% of the shares. Since the promoter and two angels own 50% of the shares, this allotted portion is called issued shares. The balance 50% of the shares, totaling 2.5 million equity shares, are retained by the company. Repeat, the number of shares 2,500,000 equity shares are retained by the company. These shares are also authorized but not allotted. Now, the company structure is good and a healthy seed fund is available. The promoter starts his business operations. He decides to open just one small manufacturing unit and one store to retail his product. After 2 years, the first 2 years of operations, the company starts to break even. The promoter is more knowledgeable about his own business and of course more confident. Now he wants to expand his business by adding one more manufacturing unit and few additional retail stores in the city. He makes the plan and estimated the fresh investment needed for his business expansion is 70 million rupees. He is now in a better situation when compared to where he was 2 years ago. The big difference is his business is generating revenues. Healthy inflow of revenue validates the business and its offerings. He is now in a situation where he can access reasonably more advanced and professional investors for investing in his business. Let's assume he meets one such professional investor who agrees to give him 70 million for a just 14% stake in his company. Because Mr. Bob's business has clear signals of revenue growth and obvious pathway to profitability. The investor who typically invests in such early stage of business is called a venture capitalist or just VC. And the money that the business gets at this stage is called Series A funding. A venture capitalist is an investor who provides capital to companies that exhibit high growth potential in exchange for an equity stake. VCs target companies that are at the stage where they are looking to commercialize their idea. After the company agrees to allot 14% of the shares to the venture capitalist from the authorized capital, the shareholding pattern will look like this. The balance 36% of shares is still retained within the company and has not been issued. Now, with the venture capitalist's money coming into the business, a very interesting development has taken place. The venture capitalist is valuing the entire business at 500 million rupees by valuing his just 14% stake in the company at 70 million rupees. If 14% is equal to 70 million, then 100% should equal to 500 million. Therefore, the company's total value now is 500 million. With the initial valuation of 50 million, there is a tenfold increase in the company's valuation now. This is what a good business plan validated by a healthy revenue stream can do to business. It works as a perfect formula for wealth creation. With the valuations going up, the investments made by the initial investors will have an impact. The shareholding and valuation look something like this. See the difference between initial valuation and valuation after 2 years. The wealth creation is 10 times by just 2 years. Things are going great. Popularity of the product grows, translating into higher revenues. Management team gets more professional, thereby increasing the operational efficiency, and all this translates to better profits. After 5 years, the company is phenomenally successful and company decides to have a retail presence in at least 3 more cities. To run the retail presence across 3 cities, the company also plans to increase the production capacity and hire more resources. Whenever a company plans such expenditure to improve the overall business, the expenditure is called capital expenditure. The management estimates 400 million towards their capital expenditure requirements. How does the company get this money? Or in other words, how can the company fund its capital expenditure requirements? There are few options with the company to raise the required funds for their capital expenditure. 1. The company has made some profits over the last few years. A part of the capital expenditure requirement can be funded through the profits. This is also called funding through internal accruals. 2. The company can approach another vendor capitalist and raise another round of vendor capitalist funding by allotting shares from the authorized capital. This is called Series B funding. 3. The company can approach a bank and seek a loan. The loan is also called debt. The company decides to exercise all the 3 options at its disposal to raise the funds for capital expenditure. 150 million from initial accruals. From other vendor capitalists, Series B funding as 5% equity for a consideration of 100 million and 150 million debt from the banker. The 100 million coming in for just 5%, the valuation of the company now stands at 2 billion. If 5% is equal to 100 million, then 100% should equal to 2 billion. Therefore, the company's total value is now 2 billion. Now the shareholding and valuation look something like this. The company still has 31% of shares not allotted to shareholders, which are now being valued at 620 million. Please note the wealth that has been created over the years. This is exactly what happens to entrepreneurs with great business ideas and with a highly competent management team. Classic real-world examples of such wealth creation stories would be Infosys, Page Industries, Acer Motors, Titan Industries, and in the international space, one could think of Google, Facebook, Twitter, and WhatsApp, etc. After 8 years, The company's success continues to shine on. With the growing success of this 8-year-old 2 billion company, the ambitions are also growing. The company decides to raise its branches out across the country. They also decided to diversify the company by new products portfolio. The capital expenditure requirement for the new ambition is now valued at 600 million. The company does not want to raise money through debt because the interest rate burden, also called the finance charges, which would eat away the profits the company generates. They decided to allot shares from the authorized capital for a Series C funding. They can't approach a typical venture capitalist because venture capitalist funding is usually small and runs into few hundreds of millions. This is when a private equity investors comes into the picture. Private equity investors are highly qualified and have an excellent professional background. Private equity investors invest with an objective to fund a large capital expenditure requirements. They don't invest in the early stage of a business. Instead, they prefer to invest in companies that already has a revenue stream and is in operation for a few years. They place their own people on the board of the investee company to ensure the company steers in the required direction. Assuming they pick up 15% of stake for a consideration of 600 million, they are now valuing the company at 4 billion. If 15% is equal to 600 million, then 100% should equal to 4 billion. Therefore, the company's total value is 4 billion now. Now the shareholding and valuation look something like this. The company has retained 16% stake which has not been allotted to any shareholder. This portion is valued at 640 billion. After 13 years, 5 years after the private equity investment, the company has progressed really well. They have successfully diversified their product portfolio, plus they have a presence across all the major cities in the country. Revenues are good, profitability is stable, and the investors are happy. The promoter, however, doesn't want to settle in for just this. The promoter now aspires to go international. He wants his brand to be available across all the major international cities. He wants at least 2 outlets in each major city across the world. This means the company needs to invest in market research to understand what people like in other countries. They need to invest in people and also work towards increasing the manufacturing capacities. Besides, they also need to invest into real estate space across the world. This time, around the capital expenditure requirement is huge, and the management estimates this at 2 billion. The company has few options to fund the capital expenditure requirement. 1. Fund capital expenditure from internal accruals. 2. Raise Series D from another private equity fund. 3. Raise debt from bankers. 4. Float a bond. This is another form of a raising debt. 5. File for an initial public offer (IPO) by allotting shares from authorized capital. 6. A combination of all the above. Let us assume the company decides to fund the capital expenditure partially through initial accruals and also file for an IPO. When a company files for an IPO, they have to offer their shares to the general public. The general public will subscribe to the shares by paying a certain price. Now, because the company is offering the shares for the first time to the public, it is called the initial public offer, IPO. Thank you for watching.